Welcome to the Master's Certificate in Technical Analysis. My name is Stu Wilson and you've reached Module 4. And this module is about reversal and continuation patterns. This shows the practical applications of the principles we've been learning about trend lines and support and resistance lines. Reversal and continuation patterns are useful because you can figure out when the stock is trading sideways and whether it's going to keep on going in the direction it's going, or whether it's going to reverse direction, and that of course is very important for your trading. Of course we divide into reversal and continuation patterns, but nothing is certain. A reversal pattern 70% of the time might be a continuation pattern. But we look for other clues. We look for the confirmation as well as looking for the patterns, so we can then try and anticipate what the prices are actually going to do. So the first part for this video, for Module 4, Part 1, is reversal patterns. These are patterns, say an uptrend goes up, hits this pattern, and then it will start to go back down again. So what are they? Again, it's a pattern you may see at the top of the trend before it reverses back down, or you can see it at the bottom before it goes back up. How do we use them? Well, if we can identify a pattern and confirm it, and then that gets us into the market as quickly as possible without waiting for the trend to become fully developed. So this can help us increase our profits, or in fact make profits in the first place. How reliable are they? Well, I'll touch on this just now. It just depends on other factors, as you'll see later in the module. But reversal patterns can become a continuation pattern and the other way around. So we do usually want to check, although some of the patterns are a bit stronger than others, and I'll cover that when I'll get to it. Some of them are pretty well guaranteed, while others, say 70% of the time. So basic principles of reversal patterns are, and in fact continuation patterns come to that, you must have a trend to reverse. Yeah, it may seem obvious, but if you spot a pattern on a chart and you go, aha, there's a pattern, you've got to make sure that the pattern actually means something. And as such, if you don't have a trend to reverse, then you don't really know what the pattern is going to mean, or going to be meaning. The other principle of reversal patterns is the size of the pattern related to the size of the move that you can expect to happen when it breaks out of the pattern. And the size of the pattern is measured in two ways. Obviously up and down is the price, and so the size is affected by the price moves, the size of the peaks, but also the pattern can be the weight from the time scale, and the size of the pattern does show us how big a move we're going to expect, and therefore how much we can make out of it, and you can get to see some of the ways that we can project the minimum price move that we should expect, so we can see whether it's a worthwhile pattern to trade. Another principle of reversal patterns is generally that when there's an uptrend, the pattern happens quickly. With a downtrend, it takes a little longer. Uptrends in general, they're a bit more motivated. You see higher values in an uptrend, whereas in a downtrend, the prices tend to come down almost under their own weight. So uptrends are quicker and more motivated sort of movement. Now, the first sign that we're going to have a reversal pattern is quite often a breaking of a trend line. This gets it going. Pattern develops to confirm it to us, and quite often there won't be a trend line. And the final point in the principles is that volume matters. You want to see volume increasing in the direction it's going to go, and decreasing with the reversal and saying it's an uptrend. You would see that each repeated peak would have less volume before it is reversed. So this is one of the easiest ways to check a reversal pattern. To validate them is to look at the volume and see that it really is what we would expect it to be from the trend. Now, the most well-known reversal pattern is the head and shoulders pattern, and we'll go through this in a little bit more detail than other patterns because the principles are pretty much the same. All the pattern really is doing is describing the motions of the markets and describing how the motions are changing, which you can then see with the price as the price moves and the volume changes. but the pattern gives us an easy reference to see where it is on the chart, instead of having to go into detail in other ways. So the head and shoulders pattern, you can see the head and shoulders here, the jagged line and a couple of other lines here. There is one marked as trend line, and we've covered that in a previous module. And you can see that obviously the trend line is underneath the low point, at least at the start of this chart, and that's what we would expect in a normal uptrend. And then there's another line called the neckline, which we'll come to later. So this first peak is labelled as a left shoulder. We didn't know that when it occurred because it was just another peak in an uptrend, but it does form the left shoulder of the pattern that we're going to see developing. The next peak is labelled as the head. Now this may go up full height like this, as you would expect, but also could be a bit lower, and you would expect to see a little less volume building up to its head peak. Then that's than what's on the left shoulder. But either way, it's still above the trend line, but it may be a little bit lower than you would expect that if it was a very strong trend. And we also see that when we get a triple top pattern later, on the triple top pattern, the head is actually the same height as the shoulders. So right, the next point to note is the price comes down through the trend line. Aha, it's broken the line, and also it carries on down and it goes on low on the left shoulder. So these are things that say, something is happening, the trend is breaking. It doesn't necessarily have to reverse, it may just be going low for a little bit, but the trend is breaking. So there is a aha moment that we have to watch out for, or that we are seeing. Now the price has gone down to practically the same level as the left point, the first shoulder, as we had first in the first peak. Usually as drawn, we have a slightly higher than the left shoulder low point, and the neckline is drawn between those two low points. Usually with an uptrend, the neckline is sloping slightly upwards, just as shown as it can be with horizontal, it can be going down. It's not a head and shoulders pattern. This is usually the way you'll see it, and certainly when you've broken the trend line, you've come down this far, that's a strong indication that something is happening here. Now, you will see that the volume is building in this right shoulder will be less than the left shoulder and the head. Now the volume of the upswing should be coming down now, and here we have the price coming down, and this time it's coming down through the neckline, which you might expect would provide some resistance, but as this is reversing, it doesn't quite go through and violates the neckline, and this is really when we know that we have a reversal as opposed to just a buzzing along the straight line as the rest of the uptrend. Here we have an indication of how much we expect the price to go down. You see I have an arrow drawn down from the peak of the head down to the neckline, and then you transpose that to the length to where the neckline was breached and run that down, and with the blue arrows pointing, that is the level that we expect the price to come down, or at least to. There are other factors that you can look at to see where you think the price is going to stop on the downtrend, which we've covered in previous modules. It may come down to say 33%, or it may come down 50%. On a rare occasion, occasionally it will even come down to 66% of the previous uptrend. Also, you can look back in history of this stock, look back at the charts and see it's been sticking before, where the support and resistance levels have been before, but this basically gives us the minimum level we expect the price to come down, and therefore an initial price target. Now the head and shoulder pattern you can also see at the bottom of a downtrend, and this is, as you can see, virtually identical, just flipped the other way round. Everything I've said applies to this one as well. Price targets again have this dotted arrow from the head to the trend line, gives us the minimum distance we expect the price to go up. In this case, the neckline as shown is probably sloping down a bit, though it can be horizontal or upwards, but this is probably the way we expect it to see this thing. Now the head and shoulders pattern can come in different forms. You can have a complex head and shoulders pattern, where you have a couple of shoulders, maybe two left shoulders and two right shoulders, because it does tend to be a symmetrical pattern, but the same sort of ideas apply. You're looking for firstly the breach of the trend line, basically saying that something is happening, but not necessarily a reversal. but then you have the breach of the neckline, then you can truly say that you have the makings of a reversal. Again, the head and shoulders pattern can fail. None of these things in trading are perfect, but what we're trying to do is play the odds, and certainly we'll be playing the odds if we go for a head and shoulders, and we confirm with the volume, we'll see that this is basically a reversal. As I mentioned, I'm now going to show you this one, triple top and bottom. This is virtually the same as head and shoulders. It just means that the head just hasn't quite come up quite so far. So it's really just about the same level as the left and right shoulders. And that applies to the top and the bottom of reversal patterns. More commonly, you'll see the double top and bottom. I'll show you this one. Here I'll show you the double peaks at about the same levels. Second peak may be a little lower. If the second peak is a little higher, then that questions the strength of whether the uptrend is changing or not. This is sometimes called an M reversal because it looks like an M, surprisingly. Having those two peaks again, you should check the volume. The volume up to the first peak would be a bit more than the volume up to the second peak, and again any uptrends after that, the volume is probably lessening quite a bit. Again, we have dotted arrows. In this case, we go from the peak level down to the trend line. It gives us the distance of the minimum we would expect the price to move. Once it's gone below the low point, it's as shown again, so we can get ourselves a price target from that. So this is quite a common pattern. It's the same pattern happening in the downtrend, or on the downtrend. In this case, it's called a W pattern, basically an M reversed. It forms, well, not so surprisingly, a W. That's what you would see quite a lot of the time. You can also get a couple of others that I won't actually start to illustrate. The saucers, or the saucer reversal, is a ramp, sometimes called a rounding bottom. And it takes place over a very, very long time. It's just a gentle curve that takes place over an extended period. This gentle curve turns around into an uptrend, and it can take months or maybe even take years for the trend to reverse with the saucers. So it's not really something that we look for as much as, say, tops and double tops and double bottoms and head and shoulders and so on. As traders, this is just a description of one way that the price can reverse, of course. The spike reversal is obviously just a sharp up, sharp down, and you'll have difficulty anticipating that. It's not a very useful one to use unless you look for indicators. Sometimes we look for indicators, and we'll be looking at indicators in one of the later modules, I think in module 7, and they can give an indication if the market is stretched. It's overbought, it's oversold, but it's really to a place where it's not sustainable. And if you get to a place where it's not sustainable, sometimes you can have that spike reversal that we were just talking about. So that concludes the discussion on reversal patterns in the second part of the video from module 4, which will be covering continuation patterns. So here we are, module 4, part 2, the Master's Certificate in Technical Analysis. This is module 4, part 2, as I've said. Here we're going to discuss continuation patterns. We discussed reversal patterns in the first part, and this is a continuation pattern. We all mentioned that sometimes these patterns can be reverse patterns as well. As I said in the introduction to this module, there are just reflections on the market, and they can go both ways, but we're playing the odds here, so we're picking a pattern that maybe just goes one way 80% of the time, and 90% of the time we just have to watch out and see if we get a pattern sometimes that goes the opposite way. Continuation patterns. So what are they? They're not as dramatic as reversal patterns. They're just as, if you like, a breathing space in a trend. You have an uptrend, then you have a continuation pattern. And the uptrend continues. So it's really just the market sorting itself out, sort of coming to terms with the way it's going. Next question is, how do we use them? Well, we use them by saying there's a continuation pattern in the trend. When we see a continuation pattern, obviously we expect the trend to continue, and obviously then we can then go back on the trend. If it's an uptrend, obviously we take a long position as soon as we feel confident that we've identified that continuation pattern. Once again, volume is important. In fact, volume can make the difference between whether the pattern is a reversible pattern or a continuation pattern, even though it's the same shape on the price channel. So the volume we look at has to confirm whether or not these are continuation patterns. Most common sort of continuation patterns that you see are probably going to be triangles. Now, there are three basic shapes of a triangle. First one we will look at is called symmetrical. Second one is called ascending, and finally the third one is called descending. Let's first look at the symmetrical one. As you can see, the triangle is surprisingly symmetrical, as it forms basically a wedge, and sometimes this is what they call it. It has a trend line or a line above and a line below, and they can kind of squeeze the price as the time goes along until eventually the price has to jump out of the triangle. The symmetrical triangle will very rarely actually result in a change of direction. The symmetrical triangle will usually be a continuation, but it could obviously change. Quite often you'll see that it has three peaks and three troughs like this, and then you can clearly draw the triangle. Here it is with a couple more lines on it. The apex is where the lines join. The base of the height of the triangle, and what we do to estimate the price is transpose the base height onto where the background breakout happens. As you can see, the arrow is connected to where the breakout happens. And another way you could go for a target price is to put the line called parallel. We draw a parallel line or a channel line actually parallel to the lower trend line, and that will give you another target for the price so you can see where it's going to be going. So it's a neutral sort of formation. Occasionally it will reverse, but generally it will go off in the same direction. Usually it will break out there between 2/3 and 3/4 of the way along. The triangle obviously has to break out before it gets squeezed out towards the apex, and that'll be about 6 points. That will quite be the 6 points like that. Next type of triangle is called the ascending triangle. The ascending triangle is horizontal on the top and with an ascending line on the bottom. And this is a different story to the symmetrical triangle, and this is where it's definitely a bullish pattern. In fact, if you see an ascending triangle via a downtrend, it will be a reversal pattern. But that's not so common. It's usually seen in an uptrend as shown here, and again it results in an uptrend. So the size of the price move is usually determined by the size of the base. An equivalent of its descending triangle, this is flat, horizontal on the bottom, and has an angle coming down. Again, you can see the arrows which measure the minimum price that should be looking forward to move. And again, descending triangle is definitely bearish. So if you happen to cross this in an uptrend, it will be a reversal. It will result in a downtrend most of the time whenever you see a descending triangle. Now, actually, there's another form of triangle that you can see. It's pretty rare, and it's called a broadening triangle. Put a question mark over the continuation there, because it's anybody's guess where it's going to go after this. This is basically saying that the market is really overheated. Lots of action is happening. It's sometimes called a megaphone reversal or a megaphone top, and as shown, is actually shown as a top reversal, which quite often happens because there's a lot of activity in the market. It's quite often an uptrend. As I said in the previous videos, we look for high volume on an uptrend, and downtrends tend to fall down under their own weight. So quite often, because this is high volume pattern, it will be an uptrend, and quite often it will finish up with a top reversal. Most of the time you probably want to watch out rather than trade this. We'll get to a more standard sort of continuation pattern next. This one's called a flag. It's probably the most common, along with the pennant, which we'll look at next. Probably the most common continuation pattern of all. And it's a short trend. It will last maybe 1 week to 3 weeks. You will see that the parallel lines slope towards downwards slightly, and this is common in an uptrend. And it will be the opposite in a downtrend. You would expect them to slope up a bit. One of the features of the flag is that you would have a sudden burst, as shown here. There's a big uptrend swing, and then almost as if it has to stop for breath for a couple of weeks, and it just stays like this before it starts off again. It's a pretty reliable pattern, so again that gives you a clue that the uptrend is going to continue and something is worth trading. The other pattern we're going to see a lot is a pennant, as I was saying, and it's very similar, as you can see, because it looks a bit like a flag, but there are a couple of differences from a flag. This isn't a flag because it's very short, and it's a very short-term pattern. Again, it will be from, say, a week to 3 weeks. The flag might be from a month to 3 months, and the other difference is that you've got this huge upswing, this steep rise into it, which is in contrast to a symmetrical triangle. Now, that's the flag and the pennant, which we'll see quite a lot. You'll also see the falling wedge. This is a longer term. This may take a month to 3 months, and this is a normal uptrend. And a falling wedge, as you can see, is a falling down to the right, sloping down. Is normally a bullish pattern, so even if you saw this downward trend, you would expect it to finish as an uptrend. So again, this is a bullish pattern, and again, it's very similar to an ascending triangle. It's a bullish pattern, you'll finish in an uptrend, but you will normally expect it to see it as a continuation, the same as the ascending triangle, but rarely if occurred in the other trend when it would be a reversal pattern. And symmetrically, the other way around is the rising wedge. Happens in a downtrend, and the rising wedge, not easy for me to say, lasts probably at least a month, if not longer, and it finishes with a downtrend. These are fairly reliable signs as well. Now we move to the rectangular formation. It's actually one that was used by Nicholas Darwis. I think I said that that he traded and had made $2 million, and he was a dunce and he was away a lot of the time, but he just used to communicate via telex and took for these particular shapes and only trade them when they came up. That's all he did, and it's an interesting book to read, Darwis's book. If you look at these rectangular formations, it's very even and symmetrical formation going up and down. You would look to the volume on this one, particularly because you want to see if the volume is strong on all of those up moves, and perhaps even strengthening when it constrains the two parallel lines, so that in the end you'll get the up move that breaks out. It would be stronger still. This is a formation that could reverse. Let's face it, this is a triple top part from the breakout going up. You've got 3 peaks there, this is the triple top. So it could quite well go down and break out after the 3rd peak, so you do need to look to the volume. As always, the pattern is only part of the story. With a future confirmation, whenever you're trading confirmation, maybe with volume, confirmation maybe with some other indicators that we'll learn about later. But generally you don't want to trade just on the basis of seeing one. You recognize, and then you need to have a couple of things to indicate that you're going to maximize your safety, and most of all your moves will be good moves. And here's just one more final example, the head and shoulders as a continuation pattern. The head and shoulders, as we know, is a good reliable reversal signal, but here it's shown as a continuation pattern. As you can see, we have a neckline, and we have after the head and shoulders, we have a downtrend. That's what we would expect with the head and shoulders. The difference here is that the head and shoulders has occurred in a downtrend, not an uptrend. So the head and shoulders is still not letting us down. The head and shoulders is still resulting in a downtrend after it. But this because it occurs in a downtrend at the start, it becomes a continuation pattern. Again, we'll be looking at volumes. We will be looking at the volumes for lots of volumes up towards the head and the shoulders. And again, the volume on the left shoulder would be less still. And we'll see that the uptrend or upwards force was weakening, and expected to see a downtrend coming out of it. So this basically concludes the discussion on patterns. The next module, Module 5, we'll be talking about volume and open interest. I'm talking about volume really on these patterns because it's important, but we'll be looking more into a little more detail in what volume really is. Really, we've been talking about prices up till now when we've been looking at trend lines. We've looked at support and resistance when we've looked at patterns. We've been considering price movements, and in the next module we'll be getting into a lot more detail on what we can expect to see in volumes. So thanks for listening, thanks for watching, and I'll look forward to seeing you on Module 5.